We're very pleased about the last 12 months in the total return fund. The Russell 2000 was down around 3%. We were up a little bit. So outperformance in a down market has been a hallmark of what we've been trying to accomplish, and we feel really, really good about that. It was really apparent in the fourth quarter of 2018 when the Russell was down 20%, we were down around 15. That 500 basis points of outperformance during really a horrific quarter, I think proves out the point that our low volatility strategy can work when times get tough. We've been talking for a long time about down market performance and what could happen, and we feel like we were vindicated a little bit this time around. And we've often talked about how we're going to lag a little bit in the up markets and hopefully do less bad in the down. And in the last 12 months, we really did that this time. Some people think it's difficult to buy small cap dividend paying tech stocks, but that's not really true. There are some areas where you can and some areas where you can't. You can divide the technology world into tangible technology companies and intangible technology companies. And by that I mean companies who make things you can put in your hand and companies that don't. And in the don't category, I'd think about software companies and internet companies. And those are the companies where we're kind of absent. So you can find us in things like capital equipment and components and distribution, plenty of technology companies with dividends that participate when technology does work. The non-dividend paying technology areas tend to be the more volatile stocks. So in our strategy where we're trying to keep volatility down, we think we're really not missing that much when we avoid software and internet companies. The value in today's market, I think, is in more cyclical areas. The market is worried about a recession and has really heavily discounted those companies that have some cyclicality. So some of the more interesting but contrarian areas today would be financial services, particularly banks, some consumer stocks, particularly in the shoe area, and many, many industrials. They could be in human capital, could be in airlines, it could be in trucks and truck part related areas, but all companies that could get hurt if there's an imminent recession, but the evidence today doesn't look like we're going to have a recession anytime soon. So there are many opportunities in cyclical areas, and if the market is wrong about the recession and it doesn't come soon, the multiple should go higher and the stock should work very, very well.